One thing to think about as you're kind of observing the market as to when to get back in addition to watching what sellers are thinking and what passive investors are thinking, watch for objective indicators like a reversal in rent growth.
Brian, welcome to the show.
Hey man, great to be here. Thanks.
So you were, I said 2.5, maybe even 3 years longer. You were, because you and I have known each other for a little while. You've been a bit of a skeptic on the multifamily space, so much so, in fact, that you stopped buying and then you started selling. One of the few people who did both. A lot of people actually did the same exact opposite. And I was wondering, at the time, 2, 3 years ago, what did you see at the time that you didn't particularly like that kind of made you step on the brakes a little bit?
I saw what I could best describe as irrational exuberance, I think is about the only way I could put it. I saw anybody and everybody becoming a multifamily investor. I saw everybody that was a multifamily investor paying incredibly high prices. It gets to the point where you're like, would I buy that asset for that price? Would I buy my own asset for the price that somebody might offer me? The answer was no. I was also seeing that as I was trying to acquire additional properties, I would get outbid by millions of dollars. And each listing that came on would get dozens of offers, and many of them with 6 to 7 figure non-refundable earnest money deposits at the signing of the contract. And when you have that much enthusiasm for a market, it's oftentimes an indicator that the pendulum has swung too far and it's going to swing back the other direction. So that's kind of when I made the decision that if there's people out there that really want these assets and they really want them at these prices, who am I to say no? They might as well take all of mine as well. And that's when we started selling.
Was there anything around, so was it more of a feeling, I suppose, that you were getting around? And I remember the time very well, and exactly what you're describing, non-refundable deposits, multiple bids above asking, things of that nature. It did feel like it was towards the top of the market, but sometimes these markets can go on for a while. Is there anything that when you said these high prices, I mean, is there anything besides the absolute dollar amount based on what you bought? Anything else that you saw with regards to cap rates or any other economic indicators, anything about the economy where it kind of made you put the brakes on?
Nothing about the economy. In fact, this is what was interesting about this market shift is fundamentally, housing was a very solid investment and still today is a very solid asset class. Housing is really, in my view, the best asset class to be in, especially over the long term. So this is what gets really difficult at times like 3 years ago was when all the fundamentals are saying that this is great, there's a lot of support to make the decision to liquidate is very difficult. And I could have been wrong. I mean, it's possible that this market would have gone on for a long time, but it already had. See, this was kind of part of the decision making was that we were in the midst of I would say 11-year bull run, maybe a 12-year bull run. That's one of the longest bull runs I've seen in my 35 years in this business. And when you watch what's happening in the market with investor sentiment, usually like right at the end of a cycle, the sentiment rapidly accelerates. So let's say everybody's pro multifamily, and this goes on for 5 years, and they're still pro multifamily, and then 7 years, still pro multifamily. And then you get to 10 years, and now you're not seeing pro multifamily. You're seeing like, I gotta have it. I gotta get into it. This is my only shot. If I don't get in, I'm gonna get priced out. I'm never gonna get in. And there's this like the enthusiasm gets amped up by a scale of 2 or 3x in a very short window of time. And this is what happened right after COVID. And so as soon as there was this like COVID lockdowns, everybody started to like retrench, like, oh, wait a minute, is this going to be really bad? Is the party over? But then very quickly, there was this rush of demand to get into multifamily, and that created an intense rush of investor sentiment. If I were to look at uh, objective indicators, things that you can quantify easily, such as interest rates, cap rates, job growth, population growth, this is the various things that you can access numerically. The scores were all in favor of investing. I would say maybe the only one that really wasn't at the time were cap rates. Cap rate compression means that anybody that owns real estate is making money because as cap rates go down, that means prices are going up. And that means if you already own an asset, you're doing quite well. But it makes it very difficult to acquire additional assets as these cap rates get more and more and more compressed. So when you start to see the delta between interest rates and cap rates erase, and you see, stuff trading at 3.5 caps, there's no compression left. And so, kind of like when you're blowing up a balloon, it gets bigger and bigger and bigger, but there's a point where you can't blow that balloon up anymore without it bursting. And this is kind of what I was seeing with cap rates, is they were getting compressed and compressed and compressed. You can't go to 2 or 1. So where do they go from 3.5? Where do they go from 3 3/4? Where do they go from 4? Really the only place they can go is level or up. And up means declining prices. Enthusiasm means that they're artificially compressed. And when you kind of combine all that stuff together, we saw a real opportune time to sell.
That was a good answer. Real quick. So when I ask you a question, because we're gonna make you talk without me, kind of summarize my question as if I didn't ask it.
10-4.
Otherwise, so it might sound a little weird, but I don't think so. It's just you're actively listening, something I
Yeah,
don't.
yeah, sure. Yeah, I got it. I got it. Okay, we'll do.
So that's really interesting, Brian. So what do you think has changed, if anything, now versus 2 to 3 years ago?
Things that have changed in the market are investor sentiment to a degree. Uh, there's a little bit less buyer enthusiasm, although I would say it's still too high for where we are in the market. Uh, Sellers' attitudes have certainly changed. I would say 3 or 4 years ago, sellers really thought their property was worth more than it was, and buyers agreed with them. Now, they still think they're worth more than they are, but they're finding some buyers that are agreeing just enough to keep a little tiny sliver of transaction velocity going. So I would say there's a little bit more realism on behalf of maybe long-term owners who have had their properties for a while. They've appreciated quite a bit. They saw the peak, they missed the peak, but now they're saying like, okay, if I want to sell, I can sell and I've made a really good profit. Short-term owners, I'm not seeing the same dynamic, right? Short-term owners are upside down. The property's worth less than their loan amount. They're panicking a little bit. I think that's another thing that's probably changed in the last 3 years is now you have some sellers that are getting really nervous about what the future holds for them. In other words, like, am I going to be able to keep this property? Is my loan going to mature before I can sell? A little bit of worry is coming into the market. There was a famous Warren Buffett quote that says to be greedy when others are fearful and fearful when others are greedy. And, several months ago, maybe even a year and a half ago or so, people started saying, like, well, everybody's getting fearful, so this is the time to buy. But in my opinion, it really wasn't, because what we were seeing at that phase was buyers were getting fearful because they weren't sure where interest rates were going to go. Buyers were fearful because rent growth was slowing down. Buyers were fearful because they weren't sure if they'd be able to raise the capital to acquire the property. But sellers weren't fearful. Sellers were like, "Hey, my property is 92% occupied. I'm getting my rents. I've got 2 years left on my loan. I've got nothing to worry about." Well, fast forward 2 years, now their loan's coming due. Uh, Now interest rates are even higher. And they're like, well, what am I going to do now? And sellers are just now starting to get to the point where they're becoming fearful of what their exit is going to look like. And when sellers become fearful is when the Warren Buffett quote really comes into play. Is that's the time to buy. The time that buyers are fearful isn't the time to buy. It's when sellers are fearful. That's the time to buy. I think that's probably the biggest change in the last few years.
Yeah, so true. So what do you think right now? What do you think is now a good time to buy? That obviously we try not to time the market, or well maybe we do. If one were to try to time the market, is now a good time to get in? Are we close to the bottom? Are we outside? Are we have we round the corner? Like what is your outlook over the next, 1 to 3 years?
Well, I think determining when to buy is probably one of the most difficult assessments you can make, right? You're trying to figure out when has the market shifted from a declining value phase of the market to level, or even better yet, an increasing value point in the market. And this is measured kind of in the same way that you would look at when the market is peaking, and just kind of using the opposite. When buyer sentiment reaches its lowest, that's when you've really reached the bottom. When and if you ever hear the buyers en masse saying real estate's toxic, it's not a good time to buy, you can't raise any money. Passive investors who might invest in apartment syndications are saying like, look, I just had a bunch of losses in these other syndicates. I'm not ready to invest in this space right now. Those wounds are still healing. When you get to that phase of the market, that's when you're reaching the true bottom. When no one wants to give you the money is really the best time to be buying. We're not quite there yet. Now, what we have seen is we've seen a bottoming of transaction velocity. Uh, Multifamily transaction velocity is down 70, 80, even as much as 90% in some markets. It's the lowest it's been in decades. And that is an indication of the disconnect between buyers and sellers not being able to get on the same page. As the market continues to mature and flatten out and start to reverse, then you'll start to see buyers and sellers getting on the same page, because sellers are going to have no choice. They have to get out of the property before the lender takes it from them. And when there's not a lot of buyers to take it from them, that's going to be a really good time to buy. And I think we're not quite there, but I think we're getting closer. Now, I would say one thing to think about as you're kind of observing the market as to when to get back in addition to watching what sellers are thinking and what passive investors are thinking, watch for objective indicators like a reversal in rent growth, uh, an expansion of absorption, a reduction of construction. These are other things that are going to be indicators that the future is going to be brighter for you. When you start to see fewer new product deliveries, that means less apartment availability in the market, less competition. That's going to mean renters are going to be aggressively pursuing what inventory is available like it used to be a few years ago. You'll see rent growth come back. That's going to be a really good time to buy.
A lot of things you described, I feel like we've already seen, specifically the sentiment around our passive investors. Anyone who's in those legacy things, they're not investing in any more multifamily. I mean, we have literally, or we used to have a repeat investment was like 55%. That dropped to essentially zero when this whole interest rate thing went. And we are now, for the first time, seeing some of those people coming off the sidelines again, like a handful who are coming back off the sideline. So the sentiment on the passive side has been awful, just absolutely awful. And having to deal with, repeated bad news, not only from us, but from other investments that they were in, reading the news. It's essentially like we and some of our peers have had to start over again. And so the majority of the investor capital we brought in is all new investors who've never invested in multifamily before. And so I don't know how much worse. I almost feel like it's gotten really worse. I'd say 6 months from a sentiment perspective was for us probably the absolute worst. And it's gotten a little better. But so it feels like to me we are from a sentiment perspective close to the bottom. Like if we can't raise whatever we raised before, now we can't buy that kind of whatever 40, $50 million property where now we're buying, 10 or $15 million properties. I don't know. It definitely feels like we're bouncing around the bottom somewhere from a sentiment. And I find it interesting, Brian, that you're paying a lot of, as much as of a data guy you are paying attention to a lot of the sentiment, the feeling that's out there in buyers and sellers. I like your distinction between both the seller sentiment and the buyer sentiment. Um, Talk about more some of the macroeconomic factors that you're seeing specifically around absorption. I think you talked about demand for rent growth, maybe even interest rates. Some of those factors that are maybe above and beyond the sentiment from a more macroeconomic standpoint.
Yeah, I would agree with you that sentiment has been falling dramatically over the last few years, in large part because many current passive investors have felt pain in their portfolios with a variety of sponsors. Bad sponsors are getting foreclosed, criminal sponsors are getting exposed. Good sponsors are seeing challenges in their portfolios. No one has been immune and really escaped from this. And this is what I talk about in my book, The Hands-Off Investor. I just recently rewrote a chapter for that book in its new release that's coming out soon that talks about market failures, or actually it talks about syndication failures. And there's really three different kinds of failures that occur in syndications. The first kind is a market failure. And a market failure is when what we're seeing now, when the market is not cooperating with the business plan. And the next kind of failure is a structural failure. A structural failure means the thing was kind of doomed from the outset. They got bad financing, too high a loan to value ratio, paid too much for the property, whatever kind of structural failure. And then the third kind of failure is a sponsor failure. And this is where the sponsors were incompetent uh, or were inexperienced, or the partnership failed and broke up. There's all different reasons why there would be sponsor failures. So what we see when there's a market failure, though, is a market failure tends to expose the other failures. And, they always say like a rising tide lifts all boats. And that when the market is really strong and good, even if your syndicate wasn't really structured well, or even if your partnership or the sponsor group wasn't a really strong partnership, when the market is great, they can just sell at a higher price a couple years from now and they escape any kind of injury from the failures that were underlying that never became exposed. But when the market goes down, all the other kind of failures become exposed, and these things start to become very challenging for people. And so a lot of sponsors have failed completely because they had all three failures, and some of them are finding themselves in a lot of trouble, and that's really concerned passive investors, and that's affected sentiment very, very much. But even good sponsors still will feel a market failure. Now they may survive it because it's not happening at the same time as a structural failure or a sponsor failure, but the market failure was still causing difficulty for that syndicate and the passive investors that are in it. So I agree with you that passive investors that are funding all of these deals have become nervous, and rightfully so. But there are other things to look at in addition to sentiment. Uh, and there's more objective indicators like construction, for example. Uh, we were at record high construction. Over the last year, more apartment units and more housing units were built and delivered than at any time in decades, if not even in history. It's an incredible number of units. And that was driven in large part by the enthusiasm that was in the market 3 or 4 years ago. Because remember, it takes 3 or 4 years to get these damn things from concept to reality. So, in all that enthusiasm that was taking place years ago, is now manifesting itself in new apartment deliveries and new housing deliveries today. And so we're still kind of in this hangover phase. What we're starting to see now is permitting has declined substantially. Permitting is a leading indicator to apartment deliveries that will come in the future. Permitting is down dramatically, at least by 50% and by higher percentages in some markets. That means that soon we're going to see fewer and fewer deliveries. Now, we thought that, or a lot of people thought that the apartment delivery surplus was going to be, old news come end of 2024. This was all going to be over with. They were all going to get built in 24. And there was a saying that came out amongst a lot of apartment owners. They called it survive till 25. And it was under the hope of two things happening. One, that new construction would be done for, and the other was that interest rates would go down. And, I hate to rain on anyone's parade, but survive till 25 is an outdated saying. I think now you need to have something like, it's going to suck till 26, or I don't know. We got to think of a new rhyme. I'm not really sure. Uh, but what builders have found is that it takes longer to get these projects finished than they otherwise might have planned. Maybe it took longer to get the permits. Maybe it took longer to get the financing. Maybe it's taking longer to find subcontractors. But these deliveries are hanging over, and I don't think they're really going to significantly decline until at least the middle of 2025, and then they'll begin to decline. And I think by 26, we'll see reduced deliveries. So I think that's one element that you can look for. The other is absorption. Are new residents applying for available apartment units? And this is very market specific, as is construction. Now, let me make sure to be clear that there are markets in the US where no construction has taken place, and they're unaffected by additional apartment supply. But the markets that have been very strong in the past are the ones that are seeing the most supply. They also saw a drop off in absorption where tenants stopped applying for units because they weren't moving there as much as they were before, or maybe job growth kind of tapered off a little bit, or whatever was the underlying reason. That's starting to turn around. In fact, just this morning, I saw an article that came out saying that Atlanta's vacancy rate just had its first month-over-month decline in like 3 years. So we're just now starting to see where apartment absorption has made a comeback. Unfortunately, in the markets where this is happening, we still have a lot of deliveries. But as those deliveries taper, assuming absorption continues, we're going to see a return of rent growth in markets where those two factors collide. And I think they'll probably collide in the middle of next year, middle of 2025. So those are things to really look for. What is construction? What is absorption? And there's a metric out there that's a really good use for this. It's called the construction to absorption ratio. And you can look at this ratio to determine whether or not, if there's 100 units constructed, how many are being absorbed? If it's 50, we got a problem. If it's 150, then rent growth is near. I'd also be looking at interest rates, and we've had some declines in interest rates. The SOFR rate, the secured overnight financing rate, which is what floating rate loans are tied to, has come down about 3/4 of a point or so from where it peaked. The 10-year, that's a real problem. And this is where a lot of multifamily, like fixed rate financing, is tied to the 10-year treasury. And that's bouncing around. It's up, it's down, it's up, it's down. That's not helpful. So does a decline in interest rates signal that the market's coming back? No, not necessarily. Interest rates could stay level, but pricing is going to have to come down to make deals pencil at higher interest rates. And is another thing to look for. That last hurrah of price decline so that we could then get back into the market with the reality of where interest rates truly are. So I'd be looking at those things more than anything. Rent growth is a great indicator. It's a lagging indicator to construction and absorption, but certainly a good indicator to be looking at. Monitor cap rates. They tell a story, but they don't give you an answer. But they do tell a story. So I'd be looking at that. Outside of that, just your typical job growth, income growth, and population growth. I've preached that for years. Even at your Dealmaker Live, I've said it 100 times at Dealmaker Live. Job growth, income growth, and population growth is what drives all income producing real estate. Monitor those objective metrics as well.
So the big question is, Brian, are you actively looking for deals? Are you finding some that might pencil, and would you be prepared to buy?
I'm somewhat actively looking for deals. I'm monitoring the market, and we see a lot of stuff come in. Every day, I get opportunities that are being launched into the marketplace. I get calls from our broker relationships about off-market deals. We underwrite a lot of stuff. We just haven't found yet that everything is gelling. Now, uh, I've long said that there's a needle in every haystack. And even in the midst of all the chaos that's going on over the last 2 or 3 years, there could have been and likely were really good deals to be had and found. They're just not very common and they're very few and far between. And of course, everybody thinks theirs is the one, but very few of them truly are. Uh, if the right deal came along right now today, would I buy it? The answer is yes. Housing is a very solid investment fundamentally. I don't think that's going to happen right now, though, because if I'm being real about where interest rates are, where cap rates should be when I go to sell, in other words, exit cap rates, where rent growth really is, what expenses really are, which is a lot higher than they used to be, uh, I'm missing the mark on a lot of these transactions. And there's other buyers out there that are successful and they're buying. I question whether or not acquisition success is going to translate to investment performance. That remains to be seen. Now, when pricing begins to come in line with all these economic realities I just mentioned, then it's going to be a really good time to buy. And frankly, I think at that point, there won't be too many buyers competing for it, which will mean that you'll be able to get stuff at valuations that are a basis that's actually reasonable given economic reality.
All right, well, that's you heard it here first. Brian might be buying if you found the right deal. That's pretty cool. You weren't saying that 2 years ago. That's
I
pretty cool.
wasn't. 2 years ago, what I said was when I would get a new deal in my email inbox, I couldn't hit the delete key fast enough. I didn't care what it was. You can keep it. Yes, this is a change. You heard it here first.
All right, let's shift a little bit, Brian. Let's talk about different real estate asset classes. This is discussion all the time. What's the best real estate investing asset class? And I'm gonna get a really good perspective from you because you've done so many things, right? There are single family flips and rentals. There's short-term rentals. There's co-living, pad splits. Then of course there's commercial, multifamily, self-storage. Right. And so the question really is, which one is the best one? And maybe the answer is, well, it depends. It depends on the market, it depends on the person. Maybe you can talk about some of the different kinds of asset classes that you've done. And you've done them, obviously, you got started into the asset class at one point, and then you scaled some of them as well. But talk about the different asset classes and kind of compare and contrast.
So I think I read the other day, there's like something around 40,000 publicly traded stocks on the stock market. And amongst all of that, these variety of stocks are in a various different industries, right? Some of them are healthcare stocks. You have some that are manufacturing, automotive. I mean, there's all these different categories of publicly traded stock. And if somebody were to ask, well, which one is the best one? What would any financial advisor say? They would say that each one has its pluses and minuses, and you should probably try to diversify your portfolio to invest across different asset or different segments of the market so that you have exposure that when one really goes up, then your portfolio benefits. And when one really goes down, you have other things to offset that. And I think real estate works a lot in the same way, where that there's a variety of different types of real estate. Uh, I'll go through some of the ones that I've done in my 35 years in this business, starting from the most basic, which is just plain dirt, an empty lot, that you can buy vacant land. You can buy vacant land to land bank. You can buy vacant land for agriculture purposes. You can buy vacant land to subdivide and build homes on that could be rented or sold. You could build apartment buildings, hotels, shopping centers, industrial sites. There's all sorts of different stuff you can do with vacant land. So there's literally like hundreds of different strategies and ways to approach just that one asset class of vacant land. And then, now let's talk about things with buildings on it. I mean, you've got things from uh, self-storage, apartments, office buildings, shopping centers, strip malls, mobile home parks, RV parks, marinas, manufacturing sites, industrial, warehouse, storage. The list just goes on and on and on. Single family homes, that's one that everybody's pretty familiar with because everybody's got a single family home. So there's a lot of different ways to invest in real estate, and there's pros and cons to each of them. And we don't have enough time in our lives to probably even understand all the pros and cons of every asset class and every strategy within every asset class. So, what I found in my career and in this business, I've done vacant land, I've done single family, I've done self-storage, I've done hospitality, single family, multifamily. Yeah, I think I hit most of it. Vacant land, subdivisions. I've done all those different things. And what I found was I was really good at multifamily. And I think it's because I started in this business as a house flipper. That's a residential strategy. I knew residential strategies really well. I live in a home, so obviously I'm very familiar with all aspects of a home, right? And I think that's one of the reasons why, like the retail investor, and when I say retail investor, I'm talking about passive investors that invest in syndications. I'm talking about mom and pop landlords. That type of investor gravitates toward the residential asset class because it's familiar to them. And so that's a very good reason to be in that asset class. So, residential has the benefit of being familiar. It has the benefit of being widely used and needed, and is one of the basic elements of human life is for, food and shelter. And shelter is extraordinarily important, and everybody understands that. So that I think is one of the biggest things, that the biggest advantages of residential real estate is that it's familiar and it's necessary. And there's different ways to approach this, right? You can invest in single family homes and flip them. You can invest in single family homes and rent them. You can invest in multifamily. I found the advantages to multifamily are that you've got scalability. You've got it works in any market cycle because you can move markets, you can sell out, you can buy at the bottom, you can hold all the way through if you've got the staying power and the right capital structure. You can, sell out of one market and buy into another market where it's working better. There's just all kinds of advantages to multifamily that you don't have as easily in single family. It's a little bit harder to say, I'm going to sell all my single family homes in California. I'm going to start buying a few in Texas, Georgia, New York, and all these other things. And to have to manage this diverse portfolio of like a single family home, it's only worth a couple $100,000, not worth the effort and the travel. So I think out of all the different asset classes, residential is the most widely accepted by most people. Now, there's advantages to investing in, say, industrial, for example, because when manufacturing is on the rise and right now warehousing is a big thing, right? As you start to like lose the retail experience in favor of the online transaction experience, and that means you need more warehousing for distribution centers, and that creates demand in that sector. But a lot of people don't understand that sector very well, and that's a disadvantage. Land has a disadvantage of producing no income. So that can be troublesome for people if you don't have the ability to service debt or pay the property taxes because you have to use sources of other sources of income to do that. Hospitality can be very cyclical, where travel is really strong, hospitality does well, then travel is very weak, hospitality does crappy. Imagine being in hospitality during COVID. It was not a fun place to be. And then, oddly enough, housing became extraordinarily profitable at the same moment. So I think there's a lot of advantages and disadvantages to every type of asset class, and you have to invest in what's comfortable to you. And I think you should also get exposure to a variety of asset classes so that you're not putting all of your portfolio into only one strategy.
Talk to me about development. So let's stay in a residential. So you're developing multifamily, for example, as a developer versus buying something that's cash flowing. And then also talk about when you're done with that, talk about focusing on one strategy versus pursuing multiple.
Yeah, the advantage of being a developer is that you can oftentimes build something for less than it would cost to buy something. So you can get a really good basis. Like, let's say you're going to go out and build a 200 unit apartment complex. When you add up all the materials and labor and everything else that it costs to construct that property, it might be less than it would be for you to go out and buy it. Now, there's times when that's not true. There are times when you can buy stuff for below replacement cost. Look at 2009, 10, 11, and 12. You could buy stuff about half the cost of what it would cost to build. So there's times when being a developer really makes a lot of sense. There's times when it doesn't. A great time to have been a developer would have been to have been a developer in 2018 or 2019 and delivering your product in 2021. That would have been an incredible time to be a developer because you would have built at a fairly decent basis before materials costs went up, and you would have sold into the COVID frenzy of multifamily buying, and you would have made a killing. Now, a terrible time to be a developer would be to start building in 2022 and delivering in 24 or 25. The developers that are right now finishing up their projects are in large part not very happy with their results. I mean, there's certainly some that are, but there's some that certainly are not. There's a lot of developers right now that can't get their projects off the ground because financing costs are too high and leasing is too uncertain. So there's times when being a developer can be really profitable, and at times there's not. There's an old joke in the development business that says every developer has either been bankrupt or will be. And I don't know if that's 100% true, but it certainly is true enough that if you want to be a developer, you need to really pay attention. You need to hope to God you time it right, and make sure that you have the right backing and the right capital behind you if you want to succeed as a developer. And when you talk about strategies and should you as an investor try multiple strategies? This is another question that comes up a lot. Like, I'm going to buy hotels, I'm going to buy multifamily, I'm going to buy some self-storage, I think I'll do a little bit of office, I'm going to develop a few things. uh, there's some people that have managed to do really well at this kind of diversified strategy, uh, but it oftentimes doesn't work out all that great because you find that you're really good at one thing. And so I'm a great case for this example because I've tried all these different things in the earlier years of my career, and now I focus pretty much almost entirely on multifamily. I have a few other side hustles, I guess you could call it. But multifamily is our core business, and I found that's what I'm really good at. And I think anybody that's in this business as an active participant will find that they're probably better at one thing than they are at others. And it's a good indication that you should probably focus on what you're really good at. Now, as a passive investor, that diversification takes on a whole different meaning because now you're essentially outsourcing your real estate investments to professionals who are good at these variety of asset classes. So if as a passive investor, would I invest in multifamily, self-storage, industrial, hotels? The answer is yes, I probably would, but I wouldn't do it all with the same syndication sponsor. I would be doing that with somebody that specializes in self-storage, somebody that specializes in development or hospitality or office. You know, I want to invest with groups that really know what they're doing in each of those specific asset classes because I don't. And so if you really know what you're doing, then great, go for it. But if you don't, outsource it to somebody who does. Now, what some groups can do successfully is they can expand their team. And let's say I'm a multifamily syndicator, that's what I'm known for. And now I think, well, you know, there's a real opportunity in office. I'm going to go out and buy an office building. That could be a little bit dangerous. But if I brought somebody in to come work for me that had been in the office space for years and really knew what they were doing, and they were leading up that branch of the business, then by all means, you know, I think you could do quite well with some diversified strategies within one sponsorship group, as long as they have that skill set.
Let's talk about your early years, Brian. When you first got started, because I want to talk about scaling, which you've done, and you've scaled multiple businesses to a high level. You have scaled rentals and flips, obviously multifamily, but you also have a lending business that you had scaled as well. But you must have gotten started at some point, you know, as a young buck, 12 years old, you must have gotten, you know, into real estate somewhere, you know, and bought some kind of rental or did your first flip or something like that. Talk to about the early days of how you got started in real estate, and then maybe how you scaled some of those businesses and maybe what you learned along the way.
When I got started in this business, I had nothing. I knew no one, and I knew nothing. So I read this book that said that you can buy real estate with no money down. And I thought, well, that's speaking to me because I have no money. So I just read this book. So now I know a little bit about real estate, at least what the book told me. Unfortunately, it's probably the worst real estate book ever written. I don't even remember what it was. But if I could buy real estate with no money down and no knowledge, then I've got to give this a shot because I had a couple entrepreneurial bones in my body. I knew that I really didn't want to work for the man for my entire life. So if I was going to take control of my own destiny, I needed to find a way to make that happen. So I was 20 years old when I made my first real estate investment. And lo and behold, I bought it with no money down. I found a finance company that would finance, I think it was like 80% of the purchase price or something like that. The seller agreed to carry back a 20% second for the down payment. And the closing costs were minimal because it wasn't a very expensive house. I might have even gotten a credit at closing for closing costs. I don't even remember. It's been so long. And I managed to buy this property with no money down, which was the only way I was going to buy property, frankly. And that was my inauguration into real estate. And I came to learn subsequently that it's actually very difficult and very rare to buy real estate with no money down, even though yes, it can happen. It's not an everyday occurrence. But if you work hard enough at it, then I think eventually you might find the opportunity. Now, just because you need to have money down in real estate doesn't mean that it has to be your money. It could be somebody else's money. Now, in this case, my down payment was my seller's money because they did a carryback. But if you can't find somebody to do a carryback, you got to find somebody else that'll give you the money. And so my next deal, I did it by, and I caution our listeners here not to follow my advice and do as I did or even do as I say. but I'm just relating my story. Your story could and probably should be different. The next thing I did is I applied for every credit card offer that came in the mail. And it's like, you're pre-approved for a Discover, a Visa card, you're pre-approved for a MasterCard, whatever it was. I applied for all of them. And when I got all these credit cards, and I got approved for them somehow, I don't know how, I got approved for them. They would have a cash advance limit. And I went to the bank with a handful of credit cards, with a stack about half an inch thick of credit cards down to the bank, and I handed them all to the teller. And I said, I want to cash advance all of these credit cards to the max limit. And the teller looked at me like I had two heads. And I'm like, just do it. She's like, okay. So we start going through all these credit cards and cash advancing all of them. And I walk out of the bank with a cashier's check that I then use to buy my second property. And then after that, I managed to convince a major bank to give me a signature line of credit. It was only like, I don't even remember, 15 or $20,000 or something like that, a signature line of credit. This is 35 years ago, so I mean that went a little further than it does today. But I used that signature line of credit coupled with the credit cards that I had since paid off after I sold house number two to buy house number three. And now I've got like three properties that I've been able to acquire and fix up and resell. And that gave me this track record, as it were, as little and thin and ridiculous as it was. I would keep track of, like, here is the address, here's what I bought it for, here's what it cost me to fix it up, here's what I sold it for, here's the before and after pictures. I had everything, and like I put it all together. And then I went and talked to a friend of a neighbor or something like that, who was like, had a few $1,000s, and they were like wanting to invest in real estate somehow. And I was like, well, why don't we buy this next place together? And if you can use your money, I've got this signature line of credit. And this was like my first my like, legit investor. And we went in on this deal together and fixed it up and resold it and made a little bit of money, and then did it again and made a little bit of money. And then now it was like, well, they told somebody, and then I was telling people, and other people at my job were like, what are you doing when all the on your days off, with this house stuff? And it just kind of naturally grew and grew. And I think this is something that I think is so important, is that people want to go out and be like, well, how do I go, raise $5 million to buy an apartment building so I can do my first deal? And it's like, whoa, 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 wait a minute, wait a minute. Let's instead focus on, what do you need to do to build a track record that you can show to an investor or a group of investors that are going to give you $1 million? That's step one. Go out there and do something. And it doesn't have to be what I did. You don't have to go buy a house and then another house and then a duplex and then a da, 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 da. That's what worked for me. That kind of natural organic growth worked really well for me. Other people take a different approach. They might go get a job, go get an MBA, get a job at a major private equity firm that does multifamily, and start at the ground floor as an analyst and work your way up the corporate ladder until you're a managing director, and now you're in charge of a portfolio. And then eventually you're like, you know what? I'm going to go out on my own and I'm going to do this. I'm going to like raise money from these. I've bought, $5 billion worth of real estate for this company. I'm going to go out on my own and go do it. That's another way you can do it. Some people take the brokerage approach. They become a multifamily broker, and they really learn how to broker apartment buildings. And maybe they even started brokering houses and selling homes, and they work their way up into commercial and become multifamily brokers. And then they get such a track record of selling this real estate that they build a following of people that have money. And then eventually they're like, I'm going to do my own deal. And I'm going to recruit these investors that I've met along the way. That's another approach. Some people go to coaching programs and they meet people who are in the business as syndicators, and they join up with them, and They join their sponsorship group in some capacity. Maybe they start out as an intern that's running around as quote unquote boots on the ground to go look at properties or drive deals or knock on doors or make cold calls. And then you kind of work your way up to where maybe you're asset managing and these kinds of different things for somebody that's already successful in the business and learn the business that way. Somehow or another, you've got to get your foot in the door and step by step, block by block, build yourself up. Now, I did it by starting with small real estate and working my way up to progressively larger properties and progressively more complex strategies. And people just took notice and came to me wanting to invest, which allowed me to then layer on and grow. Everybody's story is going to be a little bit different. What you don't do in this business, if you're trying to scale, is you don't just say, I'm going to do my very first deal. It's going to be a $30 million apartment complex, no holds barred. There's no other way for me to do this. And that's all in on that strategy. That's the only thing that you're doing to further your goal. Because if you don't succeed, you completely fail. And if you don't succeed and you feel like you failed and you quit and you give up and then you never come back and you go off and you do something else. And a lot of people fail for that very reason. I think it's very important that people find a way to get the door cracked open so that you can shove it all the way open. Scaling is very, very difficult and time consuming, and it requires dedication, it requires a plan, and it requires you to stay after it and not give up. And a lot of people just aren't able to quite get there.
Talk about the need for building teams when you scale. I remember, when I was doing single family house, you don't really need much of a team. You're just buying a house like you did, the one you live in, and then you fix it up and then you just do it again. But my observation has been in scaling my own companies, but watching others, they tend to build teams. Specifically in multifamily, for example, I think you mentioned earlier, you're partnering with other sponsors. And our ecosystem, literally all of the deals, almost all the deals that are done in joint ventures of some sort. And we have found that people who are joint venturing with each other accomplish larger things. People who have experienced advisors on their team, people have professionals on their team. To what degree did people that you came across help you scale?
Investing in real estate is a team sport. It's not an individual sport. Now, for the first decade I was in this business, I was the Lone Ranger. All I wanted to do was my own stuff. I didn't want to be bothered by anybody. I didn't want anybody else being a part of the decision-making process. I didn't want to consult with anyone. I wanted to be the guy. And that worked to an extent, but what I found in terms of scaling was when I actually opened myself up to the benefits of partnership, that's when my business really started to take off. Now, partnerships can be either side of the coin. They can be massively successful. They can be massive failures. And I think one of the biggest mistakes that people make when partnering is they partner with themselves. In other words, they go out and they find somebody that thinks the way they think, does the things they do, has the same experiences they have because it's familiar to them. And it's natural to say, like, man, you and I are like brothers. And we think the same way, we do the same stuff. We should partner up on a real estate deal. And the answer really to that is that's probably the worst person for you to partner up with. You want somebody that thinks differently than you, has different experience, brings things to the table you don't bring, and vice versa. That's where you have a real shot at success in a partnership. Now, this team sport of real estate isn't only just about partnerships, it's about teams in general. And as an individual, can you go out and buy a single family home and flip it? Yeah, you could. You could go make Home Depot runs with a U-Haul truck, pick up supplies and materials, and go to the appliance store and buy the appliances and go, hustle them in there and do all the work yourself. You could be up pounding nails on the roof. You can certainly do that. You can scale a house flipping business. So if you have a team, so first member of your team is going to be your contractor, somebody that can fix that property up so that you can focus on finding the next deal. Well, how are you going to do that? Well, the next person on your team is your real estate agents, right? Who's out there helping you find deals to buy, or bird dogs. Somebody to help you acquire real estate. Once you find a deal you can buy, you got to have somebody to close the deal. So a title company is going to be on your team. You got to get insurance. So you're going to have an insurance person on your team. When you grow into multifamily, nothing changes. You still need brokers. You still need title companies. You still need uh, contractors. You need a property manager. It might be you, but I don't recommend it. You want a professional property manager that knows how to manage the type of assets that you're managing or that you're buying. All these members of your team are not just there to help you, but they're there to give you advice and guidance. So when you're looking at buying a deal, what do you know? Well, you don't know really much of anything, right? If this is one of your earlier deals. So how do you overcome that? You ask questions. You ask your contractor, what's it going to cost to fix this place up? You ask your broker, what's this going to be worth if we do A, B, C, and D to it and put in a new roof, kitchen, windows, paint, siding, new carpet? You ask your insurance company, what's it going to cost to get my insurance? You ask your lender, what's it going to cost to get debt? All these people are there to help you. You ask your property manager, what's it going to rent for? What are the expenses going to look like after we buy it? All these people are there because they specialize in the part of the process that they're going to do for you. And they're the best one to give you all the numbers. And now your job is putting all those numbers together. You don't have to come up with everything. All you have to do is take all the information and be a deal architect to put the thing together in a way that is going to show you that the thing is actually going to pencil. And where do you find this team? You're going to find it by making phone calls. You're going to ask for references. Here's one of the best ways I found was, let's say I want to buy apartment buildings in Atlanta, Georgia, the home of the Michael Blanc brands. And I don't know anything about this market. I don't know anyone in this market. So what am I going to do? I'm going to go figure out who's selling multifamily properties in the Atlanta market. I'm going to talk to those people who are selling those deals, those brokers, and I'm going to ask them, you know, uh, you see all these properties that are, trading, and you see their financials. Which management companies out there are really getting it done? Who's like doing good reporting and really good property management? Who's doing a really good job? Those brokers are going to know, and they'll drop you some names, and then you talk to that property manager and you say like, well, who are your clients going with for insurance? And oh, well, this guy does all the insurance, so everybody in our portfolio, you call them. Do you know anybody? I'm looking at this property, it needs a ton of work, these are the things it needs. Who do you know that could fix it up? And they could say, well, these are contractors that we've worked with, and they can help you grow your team. Your team can help you grow your team. And this is what scaling is really all about. It's about putting all these people together so that you can accomplish an objective. Now, what I found even more so than the outside resources is your own inside resources. Who's in your partnership? Who's on your side of the table with you to help you do all this stuff? That's extraordinarily important. If you can get aligned with somebody that really brings a skill set you don't have, you can be a very formidable team if you have the right backing from all these other team members. This is what scaling really is. Scaling is about building a company, and building a company is really just an association of people, right? Any company, I don't care what the company does, any company has two major assets. It's human resources and it's intellectual property. Those are the two things that drive any company, and it's no different in real estate. It's no different in being a syndication sponsor. It's no different in being an individual real estate investor. Putting together the right people with the right intellectual property. In other words, what you're using to analyze deals, how you're putting all your information together, the way you're thinking about your approach, your strategy, all of those things are your IP. Layer that together with some capital, and you can scale into an incredibly large business, as I did, starting with absolutely nothing 35 years ago, and now having bought almost $1 billion worth of real estate. And anybody else that has all the information that we've given in this talk that we're doing could do it so much faster than I did because I had none of this when I was trying to grow.
Let's talk about possibly doing it faster. So, because you've been doing this for a little while and you learn a lot of lessons, and sometimes not that I regret doing certain things, but there's certain things I learned that I would do differently if I could do it again. Are there some lessons learned that you had over the years about how you would scale differently or more efficiently? Or what are some of those lessons learned?
Lessons are really only truly learned the hard way. The best lessons that you'll ever learn in this business come from your failures. When you have a success, you don't often learn very much from a success. The only thing you learn from a success is that you're invincible, that you're the greatest real estate investor of all time. Success doesn't teach you a lot. It maybe affirms the things that you're doing, unless you just got lucky by the market. But lessons learned are learned through failure. And there's a lot of different ways that you can fail in this business. And failure is kind of a necessity, as I hate to say. And people often will ask me, now that you've been doing this for so long, what would you do differently if you were starting over again? If you got to still know everything you know now, what would you do differently? And I think the real answer, if I'm being honest, is I would do nothing differently. Because as much as some of the things I did, I wish I hadn't done, they were very painful. Every single one of those things taught me something that I either did again because I did the right thing, or didn't do again because I did the wrong thing, or did differently because I did the wrong thing but found what the right thing was. And I think it's really important for people that are starting out in this business to understand that failure is simply part of the process and not necessarily something to be feared. Feared enough that you don't want to be fearless and just, go out there and go crazy and, do anything because you don't care if you fail. I mean, obviously we all do. But failure is just simply part of the process. Now, there's a lot of things I could do differently now that I couldn't do differently then, because there's so much more technology now. I mean, when I first got started in investing in real estate, email was just becoming a thing. The internet was still like dial-up modems, where you had just enough throughput to like transfer a text file if you were willing to wait 5 minutes. Now you can like hop on Google Maps and Street View and drive through a neighborhood 1,000 miles away in 15 seconds. uh, that really has sped up your ability to succeed in this business. Is just simply the delivery of information. The digital age has made such a difference. So I guess if I were to say what things could I do differently now, I would say, well, I would employ all these technologies into my business much earlier. I would I would have access to and I would utilize information at a much greater rate than I did. Instead of like reading one book a year, I could literally watch an hour-long podcast a day. I could join, virtual meetup groups that meet with successful investors all over the country on Zoom without leaving the comfort of my home. There's so many things that you can do now to connect. Bigger Pockets was a great resource where investors come together and talk about investing in real estate and share advice and stories. And that wasn't a thing. There was nobody I could write to and say like, oh, hey, what would you do? Well, now you can. So if I was starting over, one of the first things I would be doing is asking people, hey, what would you do in this situation? I've got this deal. What would you do? And said before, I used to have to figure it out and be like, well, I'm just going to do the deal and we'll see what happens. And then I go later on, I'm like, oh, I sure wish I hadn't done that deal. But I guarantee you, if I would have gone onto an online forum and asked people like, hey, here's the specifics of this deal, what would you do? Everybody would have said, don't do that deal. And I could have maybe saved myself some trouble. So I think I would employ all these technologies. Now you got artificial intelligence. We're just now starting to deploy artificial intelligence into our business at a massive rate. The things that we're doing with artificial intelligence right now are extraordinarily interesting to me, and none of it has anything to do with acquisitions. And so this everybody's saying, like, oh, how can I have AI find deals for me? No, forget about it. We're employing it to better manage our assets. And we're finding some incredible things that we're doing. And that's something that wasn't even in existence, well, even 2 years ago, let alone 35 years ago. So that's why I think that anybody listening to this can look at my 35-year career that really began scaling after 10 years, got into the groove after 20 years, and like went flying after like 25 years, could probably cut all of those at least in half, if not into quads, and do it much faster than I could have, thanks to all the things that are at your fingertips today.
Interesting topic, AI. How are you using AI to better manage your properties?
We're using AI in like three different ways right now. One is we're using it for tenant acquisition. In other words, uh, we're using it to market our available units to prospects. So it's kind of a way for us to more efficiently advertise our availability of apartment inventory. And it's a very, very interesting new approach. And we're abandoning some of the old tried and true that have been out there forever, that we're now going all in on using artificial intelligence to help us fill our vacancies. We're also using it to manage our prospect flow and manage our existing residents. In other words, like we've got a new AI system now that's a large language model that will communicate with our residents to say, like, your rent is late, right? And that's the apartment manager's job, isn't it? Your apartment manager on site is supposed to, look at the delinquency list and start making phone calls and dialing for dollars. Hey, you didn't pay your rent. What's going on? When are you planning to pay? Uh, but nobody wants to do it. So the managers, they slack off. Well, maybe they're only calling every other day, or maybe they're calling once a week, and they're not just being all that aggressive. But you know what? AI doesn't care. AI will call every 5 minutes if that's what you instruct it to do. We don't, but AI is very persistent. And will stay on top of the situation because it doesn't let emotions come into play. It can handle service requests and maintenance tickets and all sorts of things like that to make sure that things get done very, very efficiently. That's another way. Um, and gosh, now that I've talked about all these things, there's even a third one that we're doing that I can't even think of right now because there's just we're getting so like into this now of how we're using it, to manage our yes. So I did hit on all three. One was the tenant acquisition. The other was prospect management. And then the other is just like maintenance items and delinquencies and that sort of stuff. So all kinds of different ways to make the operations of your property go a little bit more efficiently for your site staff. And not only does that save your site staff time and aggravation, it can in some cases perform better than your site staff because, as I said, it's persistent. But it can also cut down on some of your labor costs because maybe you don't need quite as much personnel if you have AI doing some of these tasks.
It's been great jamming with you, Brian, as always. How can people connect with you? Also, where can people find your book, The Hands-Off Investor?
They can connect with me through our company website for Praxis Capital. That website is praxcap.com. It's praxcap.com. You can also follow me on Instagram at Investor Brian Burke. Or you could catch me on Bigger Pockets, on the forums answering questions, or on passivepockets.com, the new wing of Bigger Pockets for passive investors. And you can get the book at biggerpockets.com/syndication book. That's direct from the publisher. If you buy it from them, you get some bonus content that includes 100 questions to ask your syndication sponsor. Or you could also buy the book at Amazon or any online or physical book reseller. You just don't get the bonus content.
Dude, awesome. It's been too long. Really had a blast. Thanks for being on the show today.
Thanks for having me here.